Welcome to 2025, everyone. We just closed the chapter on 2024 and are prepared to write a new one in 2025. Right now, I'd like to take this time and thank you for your trust, partnership, and shared successes throughout the year. Your journey matters to us, and we're honored to be a part of it. As we step into the new year, Hall Wealth Management would like to extend our heartfelt wishes for health, happiness, and prosperity to you and your loved ones. Here, we're all about keeping you informed and prepared. It's our top priority. So let's do just that. We're excited to dive into what lies ahead in 2025. First, let's cover economy. 2024, business owners said they were waiting to wrap up capital expenditures, also known as CapEx, until after the election. CapEx are funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. CapEx is often used to undertake new projects or investments by a company. The market seems ripe for a resurgence of CapEx in 2025. Other than consumer spending, the other main components of the private sector are net exports, change in inventories, and business fixed investment, which is the broadest category of CapEx. Further, the demand for power and communication structures are on the rise. Equipment spending is slated to increase, and research and development is making up more of the U.S. economy. All of this suggests upside to business spending in 2025. Demographics will likely be a tailwind to growth in the coming years. Millennials are just about to enter the peak earning and peak spending years. Because of the amount of households who refinanced mortgage debt in 2021, and because of the rise in real disposable income from a tight labor market, we should see some continued strength in consumer spending. By the time we approach 2030, about 75% of the labor force will be millennials. Outside of the raw economic forces giving the economy a demographic tailwind, the greatest intergenerational wealth transfer is about to start, and millennials and those younger will be the beneficiaries, further straightening the consumer in their peak spending years. Higher income households are the ones driving consumer spending and incidentally, the ones least impacted by pandemic-induced rises in rents. They're also the ones least impacted by tariffs, according to research surrounding the Trump-Biden tariffs. So, the key point here is investors need to watch what the upper income consumers are doing, where they are shopping, how they are managing expenses, and much more, because they will be leading indicators for the rest of the consumer metrics. Now pay close attention. This is everyone's favorite topic, inflation. Inflation is decelerating, but not nearly as fast as the Fed would like. Barring any supply shocks and extreme tariff policies, we don't expect inflation to reaccelerate, but the path to 2% is slow, difficult, and tiring. Complicating things is the stickiness of owner's equivalent rent, which is also called OER, an attributed cost and not an actual cost affecting people's pocketbooks. For anyone wondering, owner's equivalent rent, OER, is the amount of rent that would have to be paid in order to substitute a currently owned house as a rental property. Other sticky components like medical care services and insurance have kept inflation rates elevated. The slow and sluggish path to the Fed's target of 2% means the Fed will likely take a cut and pause cadence in 2025 with a total of 425 basis point cuts throughout the year. Any other concerns about the economy? If you have any other concerns or questions about the economy, feel free to reach out to me. Now we're going to dive into stocks. The bull market has entered its third year, having celebrated its second anniversary on October 12, 2024. The S&P 500 is up nearly 70% since the move began, with a booming year two, which was plus 32%, following an average but respectable year, which was 21%. A surprising resilient economy, unwavering trends in technology, moderating inflation, the start of the Fed's rate cutting cycle, and a strong earnings recovery after the earnings recession ended in 2023 have driven much of the gains. History suggests that this bull market has a good chance to celebrate its third anniversary. In the absence of recession, the odds that a 2-year-old bull market gets to 3 are solid. For bull markets that get through year 3, the average gain for the S&P 500 is 5.2%, with 6 positive years out of 8. The bulls that didn't make it through year 3 were ended by recessions, an overly aggressive Fed, or in the case of 1987, excessive speculation. We believe the chances of another positive year in 2025 without the start of a bear market decline are quite good, but history tells us to expect modest gains. Longer term, the history of bull markets offer cause for optimism. Since 1950, excluding the current period, S&P 500 bull markets have averaged 61 months and have produced average cumulative gains of 167%. In other words, while volatility along the way is to be expected, this bull market could still have legs. One of its longest pauses in history, the Fed cut interest rates in September and November. Now, the question is how much support additional cuts may provide for stocks in the year ahead. Based on the 9 major rate hiking cycles since the 1970s, the S&P 500 have generated relatively modest average returns of 5.5% during the 12 months following the initial cut of a cycle. Taking out the recession-plagued outliers of 2001, 2007, and 2020, the median gain has been 10.8%. Prospects for solid returns in 2025 are favorable if the economy avoids recession. That does not, however, mean we should not expect volatility. In fact, even in non-recession periods of 1984, 1989, and 1995, the S&P 500 experienced pullbacks of between 5 and 10% along the way to double-digit 12-month returns after the initial Fed cut. The earnings growth picture is much improved from a year ago. In the past year, stocks went from an earnings recession and widespread recession fears to a now widely held consensus view that the U.S. economy would continue to grow steadily, though perhaps at a slower pace than recent trends, and that corporate profits would grow double digits. In response to improved corporate profit trends, LPL Research is maintaining its S&P 500 earnings per share, which is EPS, forecast for 2025 at $260, in line with the long-term average earnings growth rate near 10%. For 2026, LPL Research is initiating a 2026 S&P 500 earnings per share forecast of $275, which is 6% above 2025. Broadly, corporate America will get some help from AI investments and related productivity gains. The Magnificent Seven are expected to grow earnings by an average of 17% in 2025. Banks and energy companies should benefit from deregulation in Washington, D.C. However, potentially slower economic growth, the potential for rising borrowing costs, and tariffs are among reasons to expect modest earning gains in 2026. Cuts to corporate taxes also offer potential upside. With positive sentiment at record extremes by some measures, risk may be growing for a near-term correction. In fact, U.S. households are as confident as they have ever been that stocks will move higher in the year ahead. Though some sentiment readings, such as those taken from the options market, are more subdued, whether you notice signs of overconfidence or overexcitement in the market, this is a reminder to stay disciplined in your approach. Once again, if you have any questions or concerns about stocks in 2025, please reach out to me. Now we're going to cover bonds. Current market pricing suggests that the Fed will take the Fed funds rate back to around 3.5 to 3.75% in 2025. If the markets are right and the U.S. Treasury yield curve essentially reflects its historical upward sloping shape, that likely means the 10-year yield should remain around current levels. The spread between the Fed funds rate and the 10-year Treasury yield has averaged around 1.1% in non-recession periods, meaning the 10-year yield on average has been higher than the Fed funds rate by around 1.1%, although with a large range when not in recession. So unless or until economic data starts to show signs of a sustained slowdown, the 10-year could fluctuate between 4 to 4.5% to start 2025. But if the economy does show signs of slowing, the Fed could cut rates more than what is priced in, which would mean the 10-year Treasury yield could get back into the 3.75 to 4.25% range to end the year, which is our expectation. Treasury term premium is the additional compensation required by investors who buy longer-term Treasury securities. The term premium, which is unobservable and hence must be approximated, considers a variety of factors, including Treasury supply and demand dynamics, foreign central bank expectations, and the possibility of future inflationary pressures. And after years of a negative term premium, investors are just now getting compensated for owning longer maturity Treasury securities. But that additional compensation is still below longer term averages. So, how does this affect fixed income investors? A positive term premium could keep longer term interest rates elevated, perhaps reducing the diversification benefits of core bonds. Regarding the former, while monetary policy expectations will continue to be the dominant driver of interest rate changes, Fed rate cuts might not work as intended, and long-term interest rates may not drop as much due to the current positive term premium. While we expect Treasury securities to remain the go-to safe option during major market downturns, they might not be the best defense in smaller, more typical stock market declines. While economic growth will remain the driver of interest rates, a secondary risk to rates remains the amount of Treasury debt needed to fill federal budget deficits that are expected to stay elevated. Per the Congressional Budget Office, the U.S. government is expected to run sizable deficits over the next decade, to the tune of 5 to 7% of gross domestic product, which is GDP, each year. And to fill those deficits, the Treasury Department will need to issue trillions more in Treasury securities. But complicating the math for the Treasury Department, it will also need to roll over more than $6 trillion in Treasury securities set to mature in 2025. This meaning the Treasury will need to find investors for some $8 trillion of Treasury debt over the next 12 months. But despite the mountain of debt and growing interest rate payments, the U.S. government is not at risk of financial collapse, nor are there concerns as such. As long as Treasuries are considered risk-free securities, there will always be buyers of Treasury. Full stop. But with the Republican sweep of Congress and the White House, the deficit will likely remain broadly unchanged at elevated levels in the coming years, or perhaps even grow given what we know so far about Trump policy proposals. And with the amount of Treasury supply, interest rates may need to stay higher than otherwise expected given economic data alone. Let's get into seizing opportunities in a changing market and cover alternative investments. We expect lower rates and shifts in politics would be key drivers of the markets for 2025. Equity market neutral strategy will be one of the beneficiaries of the backdrop as the uncertainty surrounding the new Trump administration policies may lead to increased market volatility and divergences between individual stocks and sectors versus the broader market. And this expectation is well reflected on the pairwise implied correlation of the S&P 500 components. And just so you know, pairwise correlation is a commonly used term that basically shows the average correlation of every possible pair combination of a data set. For S&P 500, it would be every possible pair you can come up with using the 500 underlying companies. We've seen the exception of divergence materializing this year, and we expect this to continue in 2025 as market participants digest these changes and subsequently begin to distinguish between stocks that are positively and negatively impacted. Strong fundamental, long and short, and market neutral stock pickers should benefit and should become increasingly attractive. We remain positive on multi-strategy pod shops as they continue to deliver results that prove they are more than the sum of their parts. These managers can be considered as in-house funds of funds with their own capital allocation committee and risk management oversights. This helped them deliver returns with strong risk-adjusted returns over time, while managing relatively low correlation to traditional markets. With the strong interest from investors and solid performance, these shops have grown faster than the rest of the hedge fund industry. So we constantly monitor if there's any alpha decay or performance dilution. As of today, we don't see any signs of that, and we continue to believe multi-strategy should be one of the key allocation within alternative investments. Of course, manager selection is a key here, as their performance widely varies depending on their core strategy, geographic exposure, and capital and market risk management rules. Now we're going to get into international relations. I've successfully navigated a series of high-risk scenarios throughout the history. Even significant market downturns caused by recessions, strange unfamiliar shocks, or liquidity meltdowns have ultimately led to stronger, more resilient markets with more attractive valuations. Okay, let's get into commodities a little bit. One of the most significant commodity supercycles is closely associated with China's massive infrastructure build-out. Expectations for another supercycle have been thwarted by slower Chinese economic growth and more specific global construction projects rather than the massive and unbridled expansion underpinning China's double-digit development. The dollar continues to reign across global currency markets. Solid economic growth, especially compared to other developed countries, has been a major driver of strength and stability in the greenback. Developing uncertainty over the trajectory of inflation, expectations for gradual easing from the Fed, and positive interest rate differentials have further supported the dollar. President-elect Trump's proposed tariffs could elevate currency market volatility and stoke inflation fear, putting additional upward pressure on the dollar. Based on this backdrop, we believe the dollar will be well supported in 2025. We expect limited downside risk, while meaningful upside could be capped by the gravitational pull of Fed easing. From a technical perspective, the US dollar index has been contained within a range over the last 2 years, marked by support near 100 and resistance around 107. And while recent upward momentum could push the dollar into the upper end of the range, a breakout appears unlikely given the Fed's rate cutting cycle will likely continue throughout 2025. Come to the end of our wrap up. And I want to thank you again for making 2024 a remarkable year. Your trust, collaboration, and commitment inspire us to continue striving for excellence here at Hall Wealth Management. 2025 is a fresh canvas, and we're excited to face it with you, armed with lessons learned, goals set, and a shared vision for success. So, here's to a year of growth, opportunity, and new achievements. From all of us at Hall Wealth Management, we wish you a prosperous and fulfilling 2025. Let's make it extraordinary together. Feel free to stay connected, stay informed, and let's continue building a bright future. You can reach out anytime, and we're here to help you every single step of the way.